Hello, if you're new to the channel, welcome. In this video we will talk about the volatility index of SP500. We will explain what it is, the way it works, and how an investor can interpret this index to read the market. The VIX Index is a stock index that values the price of the stock options that make up the S&P 500 index. This index measures expectations for Standard & Poor's 500 shares over the next 30 days. The VIX Index emerged in 1993 and has since become known for measuring the market and stock volatility in real time. That is, it assessing the change in the price of a stock over a period of time. Therefore, the index has become a tool to serve as a basis for short-term trades made by market speculators. History of the VIX. The VIX was the first successful attempt to implement a volatility index. Introduced in 1993, it was originally a weighted measure of the implied volatility of 8 sell and buy options in the S&P 100. In 2004, it expanded to use options based on a broader index, the S&P 500, which allows for a more accurate view of investors' expectations of future market volatility. VIX values above 30 are generally associated with high volatility as a result of investor fear or uncertainty, while values below 20 often correspond to less stressful times, even complacent in markets. What is the composition of the VIX Index? The index's calculation is done by the Chicago Board Options Exchange, CBOE, and is valid for 30 days. So the higher the VIX is, the higher the volatility. In this way, the more prices vary, the more investors and traders become apprehensive. By representing, in a way, market volatility in general, the VIX Index became known as the Fear Index. That's because the S&P 500 brings together the most important U.S. stocks. Therefore, as the U.S. financial market influences global investments, the index ends up impacting a number of investments. How is the volatility of this index being calculated? The concept of the volatility index was created by financial market researcher Robert E. Whaley. In 1992, the Chicago Stock Exchange was in charge of creating a formula for benchmarking the index. The calculation of the VIX is fully automated. In summary, USATOs a series of share buying and selling data. In addition to the average price, time, and variation rates. The official result involves a number of complex formulas. When ready, the VIX Index can be an important tool to map up to crises in the financial market. Many investors and traders use the index to try to profit from market variation. Application in volatility has become more common. 1. Invest awaiting stability. 2. Apply on stocks with low VIX index awaiting appreciation. How to analyze the VIX and take advantage. The VIX chart generates vertical peaks that reflect periods of high voltage, induced by economic, political, or environmental effects. It is better to observe absolute levels than to try to interpret these irregular patterns, and to be alert around large round numbers such as 20, 30, or 40 and near previous peaks. Together one should pay attention to the interactions between the indicator and the moving averages of 50 and 200 days, and with these levels will act as support or resistance. I hope you enjoyed this brief and simplistic analysis. The numbers used are rounded values, and the opinions given are just my personal perspective. It is not a recommendation. Leave suggestions in the comments of indexes that would like to be analyzed in next videos. Thanks for watching and good business.